Realigning portfolios. Survey shows appetite for gold amid desire for diversified assets. As investors in Hong Kong and Singapore look to put cash to work despite rollercoaster markets and lingering uncertainty, diversification via resilient assets is a priority. This is also giving gold a bigger role in portfolios, finds a recent sentiment poll by AsianInvestor and State Street Global Advisors. Watch and read more insights into allocation trends and the case for gold. Video: Realigning portfolios, a growing role for gold in asset allocation. Webinar highlights: Gold shines as source of resilience in uncertain markets. Webinar replay: Rethinking portfolios for a new era, diversifying in uncertain markets. Today's dynamic macro, market and geopolitical landscapes require investors to be agile and measured in how they allocate and manage their assets. In particular, the frequent bouts of volatility offer regular reminders about how unpredictable the economic outlook actually is. And with the outcome of events such as rate cuts in many developed economies, and the US election, being beyond investors' control, the focus is on how to realign portfolios in preparation for what's ahead. For many family offices and private wealth managers in Hong Kong and Singapore, this means diversification and resilience, both to manage risk and to shore up returns. Reflecting this approach, demand for high-quality and safe haven assets, including gold, has soared and remains strong. Long-term capital growth is a key overarching goal. These were some of the views of over 60 fund selectors and other senior investment specialists at family offices as well as international and regional private banks in Hong Kong and Singapore, gathered in mid-2024 by AsianInvestor in collaboration with State Street Global Advisors. 7 Survey takeaways. Investor sentiment at a glance. Long-term capital growth will be the primary driver of allocation decisions for the rest of 2024, followed by portfolio diversification. Geopolitical tensions represent the predominant investment risk for portfolios today. Investors are broadly split between investment-grade bonds and global equities as the assets most likely to generate reliable risk adjusted in the second half of this year. On balance, many more investors have increased exposure to gold than reduced it over the past 6 months. Expected changes in allocations to gold over the next 6 months show nearly half of investors looking to increase exposure, driven by a desire to diversify portfolios and manage volatility. Being more active in asset allocation is the most appealing way for investors to manage risk in today's environment. Increased diversification across asset classes is the preferred option to enhance returns. Adapting to an uncertain future. Taking a broader and longer-term view of portfolios is a natural response to what many investors consider as the biggest investment risk for their portfolio today: geopolitical tension. Survey respondents identify this factor as by far their most pressing concern, with others eyeing inflation and a potential credit crunch as the main risk. However, while the US economy has slowed, plus with the forthcoming election, global monetary policy and geopolitical risks each potentially triggering some market uncertainty, a recession doesn't look imminent, according to HSBC Global Private Banking's latest outlook. It's easy to feel nervous about the markets, but we are optimistic that diversified portfolios will continue to do well, said Willem Sells, Global Chief Investment Officer, Global Private Banking and Wealth at HSBC. Many investors in the survey support this view, based on what they said are their main drivers of investors' allocation decisions in reaction to the new macro regime and shifting narratives. For example, amid the lack of clarity about what the market will do next, the goal of long-term capital growth is having the biggest influence over how survey respondents deploy their capital, at least for the rest of this year. Portfolio diversification is next in line, followed by cash yield or income, and the increase in market volatility. The desire to be diversified and look longer term was reinforced by the rollercoaster in equity markets in early August. Not only did this sell-off illustrate how quickly things can turn, but it also was further evidence of the relatively short memories of many investors. It proved how easily some investors can forget such big market events, without preparing for the possibility that they might fall into the same trap again. At the same time, however, given that market corrections are a natural part of the investment cycle, and the market quickly rebounded after the sell-off, it was a reminder that staying invested is important. We strongly advocate active management to diversification and solid risk management practices to navigate volatility, protect portfolio performance and generate alpha, added Karen Tan, head of managed solutions for Pictet Wealth Management in Asia. Many investors agree. When considering which approach is most appealing when managing risk in today's environment, the majority of survey respondents opted for being more active in asset selection. At the same time, staying focused only on the long term remains important for some, while greater diversification in the short to medium term was also a relatively popular choice. These findings are especially interesting in the context of another trend the survey highlighted: the extent to which investors are adapting to shifting regimes via changes to the average investment horizons for both their strategic asset allocation, SAA, and tactical asset allocation, TAA. In short, since early 2024, more than one-third of respondents have either increased or reduced their SA investment horizon, and over a half have a new TA investment horizon. Finding reliable risk-adjusted returns. Despite dramatic market swings, investors continue to look for buying opportunities and realize the need to put more of their cash to work again. Rate cuts, corporate earnings improvement, and a boost to productivity from innovation also fuel this trend. While the landscape is shifting, the opportunity set is rich and diverse. A global mindset and a multi-asset approach are the way to go, explained Sells at HSBC. For many investors in Hong Kong and Singapore, high-quality assets are high on the preferred list. Based on the survey, 60% of respondents believe either investment-grade bonds, 32%, or global equities, 28%, will provide the most reliable risk-adjusted returns in the second half of 2024. In trying to put the large amounts of cash on the sidelines to work, longer duration and high-quality assets suit the generally more cautious investment mindset. This also bodes well for Asia. According to Chuk Won Fan, Chief Investment Officer for Global Private Banking and Wealth at HSBC in Asia, the region's diverse and expanding capital markets offer attractive prospects for diversification, with promising opportunities from its resilient growth leaders and quality bonds. With expected GDP growth of 4.7% in 2024, Asia's economic engine benefits from structural trends, AI-driven innovation, and an investment boom fueled by the supply chain revamp and green transformation. A compelling case to hold gold. There is also an ever-sharper focus on safe haven assets against the current market backdrop. The survey findings, that around two-thirds of respondents have allocations to gold, align with discussions that Robin Sui, Asia-Pacific gold strategist at State Street Global Advisors, said he is having with clients in Hong Kong and Singapore. These investors want some kind of protection against market risks, he explained. They've been using gold allocation as a way to improve their risk-adjusted returns, and also to hedge against potential equity market downturn. The survey shows the growth in demand since early 2024. Around a quarter of respondents added more exposure to gold in this time, compared with 9% who reduced it. Perhaps most notably, this trend is expected to gain momentum in the second half of 2024 and into 2025. More specifically, 45% of survey respondents expect their gold allocations to increase during this time. There are growing needs for investors to increase their allocation into gold, added Sui. We may have clients in Singapore or Hong Kong that have 2%, but they're thinking about increasing to, let's say, 3% to 4%, just to have the higher allocation to gold. Some investors are even more bullish. According to the survey, 10% of respondents plan to boost their exposure by more than 5% over what they own today. Some of the leading private banks are also strong advocates of the asset class. They have been consistently telling clients they should have at least 5% of their asset allocation in gold. And with so much volatility around, investors should want gold as a buffer in their portfolio. Heightened risks spur drive to diversify. While the survey revealed several factors shaping investor appetite for gold, portfolio diversification was the key goal for half of all respondents. If you look at the market environment right now, equity markets are getting stretched, and also interest rate and market volatility are getting higher, as well as the Fed, ECB and other central banks start to cut rates as well, explained Sui. Added to these dynamics is the uncertainty over the potential outcome of the US presidential elections, which will in turn impact market volatility. If we're looking at the rising tension around the world, there is a need for clients to have an asset class that has extremely low correlations to stocks and bonds, Sui added. More broadly, increased diversification across asset classes might well be the most effective way to enhance returns in today's environment. This was the consensus among survey respondents, although they are also in favor of implementing more innovative investment themes as well as more closely scrutinizing active manager performance. For more information on gold, contact State Street Global Advisors Singapore or State Street Global Advisors Hong Kong. Important risk disclosures. For investment professionals' use only. This article is provided for informational purposes only and should not be considered investment advice or an offer for a particular security or securities. The views and opinions expressed by the speaker are those of his or her own as of the date of the recording, and do not necessarily represent the views of State Street or its affiliates. Any such views are subject to change at any time based upon market or other conditions, and State Street disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of State Street. Neither State Street nor the speaker can be held responsible for any direct or incidental loss incurred by applying any of the information offered. Please consult your tax or financial advisor for additional information concerning your specific situation. This article cannot be used for commercial purposes, and should only be used in the specific countries as restrictions exist with some products and services marketed globally. All information is from SSGA unless otherwise noted and has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability or completeness of, nor warranty as to the current accuracy, reliability or completeness of, nor liability for, decisions based on such information, and it should be relied on as such. The information provided does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status or investment horizon. You should consult your tax and financial advisor. All material has been obtained from sources believed to be reliable. There is no representation or warranty as to the accuracy of the information, and State Street shall have no liability for decisions based on such information. The views expressed in this article are the views of the SPDR Gold Strategy Team through the period ended the 30th of June 2024 and are subject to change based on market and other conditions. This document contains certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. The whole or any part of this work may not be reproduced, copied or transmitted, or any of its contents disclosed to third parties without SSGA's express written consent. Diversification does not ensure a profit or guarantee against loss. Investing involves risk, including the risk of loss principal. All forms of investments carry risks, including the risk of losing all of the invested amount. Such activities may not be suitable for everyone. The World Gold Council name and logo are a registered trademark and used with the permission of the World Gold Council pursuant to a license agreement. The World Gold Council is not responsible for the content of and is not liable for the use of or reliance on this material. World Gold Council is an affiliate of the sponsor of SPDR Gold Trust. Investing in commodities entails significant risk and is not appropriate for all investors. Commodities investing entails significant risk as commodity prices can be extremely volatile due to a wide range of factors. A few such factors include overall market movements, real or perceived inflationary trends, commodity index volatility, international, economic and political changes, change in interest and currency exchange rates. Assets may be considered safe havens based on investor perception that an asset's value will hold steady or climb even as the value of other investments drops during times of economic stress. Perceived safe haven assets are not guaranteed to maintain value at any time. There are risks associated with investing in real assets and the real assets sector, including real estate, precious metals and natural resources. Investments can be significantly affected by events relating to these industries. The S&P 500 index is a product of S&P Dow Jones Indices LLC or its affiliates, S&P DJI, and have been licensed for use by State Street Global Advisors. S&P, SPDR, S&P 500, US 500 and the 500 are trademarks of Standard & Poor's Financial Services LLC, S&P. Dow Jones is a registered trademark of Dow Jones Trademark Holdings LLC, Dow Jones, and has been licensed for use by S&P Dow Jones Indices, and these trademarks have been licensed for use by S&P DJI and sublicensed for certain purposes by State Street Global Advisors. The fund is not sponsored, endorsed, sold or promoted by S&P DJI, Dow Jones, S&P, their respective affiliates, and none of such parties make any representation regarding the advisability of investing in such products, nor do they have any liability for any errors, omissions, or interruptions of these indices. The trademarks and service marks referenced herein are the property of their respective owners. Third-party data providers make no warranties or representations of any kind relating to the accuracy, completeness or timeliness of the data and have no liability for damages of any kind relating to the use of such data. Hong Kong, State Street Global Advisors Asia Limited, 68/F, 2 International Finance Center, 8 Finance Street, Central, Hong Kong. T, +852, 2103, 0288. F, +852, 2103, 0200. Singapore, State Street Global Advisors Singapore Limited, 168, Robinson Road, number 33201 Capital Tower, Singapore 068912, Company Reg. No. 200002719D, Regulated by the Monetary Authority of Singapore. Telephone, +65 6826 to 7555. Facsimile, +65 6826 to 7501. Tracking code, 7232832.1.1. Asia Pacific. INST expiration date, the 31st of August 2025. Information classification, general.